Market volatility in your retirement investments. The market movements this week have been enough to make some Americans anxious about their 401ks. Joining us right now is Ramsey Solutions financial expert, author of Retire Inspired, Chris Hogan. Chris, good to see you. Thanks so much for joining us.
Thank you.
I sort of want to say don't do anything in periods of volatility like this. What's your message to people who might be a little unnerved by these market moves you've been experiencing?
Well, I think it's okay to be emotional, but what we don't want to do is to be irrational. So I would tell everyone to just take a collective deep breath. We've seen this movie before. We've seen what happens, and we know the rally is coming. We just need to be intentional and make sure we're working a plan, Maria, and have confidence in the plan we're working based on our goals, our risk tolerance, and our timing.
Well, I know you're not going to trade your 401k, Dagan.
No, and I
neither am I.
But what you saw in the shakeout just in the last week were people who were treating the stock market and even Bitcoin like a casino. It's actually worse than betting on a coin toss, Chris. You saw people, billions of dollars is piled into these short volatility funds that blew up in people's faces. And these are individuals who lost money. And I think that because when the market goes straight up, people become delusional about their own investing ability.
Yeah, and like somehow, in 2006, housing prices could only go up.
Right. People who got no money down loans and were flipping condominiums in South Florida. It's the same thing. And I know that part of what you do is to try and educate people about not becoming delusional about their own investing ability just because the market's going up in a straight line.
Well, Dagan, you're right. You know, whenever the market's growing like that, and it's been growing literally since fall 2016, it gives people false confidence, and people start to take unnecessary risks at times where they really shouldn't. And so I would want everyone just to take a collective deep breath, be aware of what it is you're doing, but also your expected time frame, and above all, don't go it alone. The worst thing we could do is rely on our own information. You need to talk to professionals that are educated, that have a track record, and truly understand where you
I got to push back on that. Investors today are armed with a lot of information, and many investors have and have been successful in terms of making their own decisions. And on that, when you're talking about speaking to a professional, what, so that they could fee you to death?
Well, no, I'm talking about, now, there's a difference, Maria. There are always the bad ones out there. I'm talking about the ones that have the heart of the teacher, the ones that I work with out there called SmartVestor Pros that plug in and sit down and talk with people to educate them, not just sell them something.
I'm just saying you better ask your broker or whoever you're dealing with what your fees are before you get into a conversation, Ryan, because you don't have to pay an enormous amount of money to trade stocks and to get an investment idea.
And it's easy for those of us who have a lot more of time ahead of them in their career to weather these ups and downs. But what about people that are planning to retire in the next couple of years that still might live for another 20 or 30 years, so they can't get entirely in bonds? They've got to have a lot of money in the stock market. What's your advice to folks like that?
Well, the advice there is to make sure you're diversified. I mean, it's very, very important that we never put all our eggs in one basket. So take a look at growth stock mutual funds. Understand the mix with that, with growth, aggressive growth, understanding those opportunities that you have as a way to diversify. But also, let me say something to millennials. I want to encourage millennials out there, don't allow this hiccup in the market to cause you to stop investing or pull money out of your 401k. A bad decision today, a knee-jerk reaction today could cause you major financial losses for the future. Stay calm, stay plugged in, and work your plan.
Chris, it's Pete Hegseth. You know, the markets have been volatile, but ultimately we have seen in the real economy wages increasing, job opportunities increasing, businesses hiring. What's the connection? Do you see any connection between volatility in the market and what's actually impacting people on Main Street?
Well, I think we have a result right now of a little bit of a correction. You know, things have been climbing steadily since 2016. Now we're seeing a little steam come out, a little bit of a correction. But I agree with you. Confidence is high. You know, unemployment is as low as it's ever been in 17 years. The average wages have climbed and reached. Confidence is high. So we just need to be steady, stable, and avoid the Chicken Little syndrome right now just because of this market hiccup.
I just want to raise the issue of where was Elizabeth Warren and her Consumer Financial Protection Bureau as all of these new exchange-traded products were created that essentially blew up on Monday, that were sold to retail investors. I know, read the prospectus, the risks are disclosed, or just people trading cryptocurrencies.
Yeah.
All the people out there
I'm
treating
still
it
holding
like
on to
it's...
mine. Don't worry about it. You just got upset.
No, but again, it's recklessness. There's no regulation of those markets. So where is Elizabeth Warren in all this? Where was she when Wells Fargo was up to no good?
Yeah.
I just wanted to raise that. I had that conversation last night.
Well, you're right, because, I mean, even the worst of them all, the Wells Fargo phony account scandal, the Consumer Protection Bureau didn't even call. It was the LA Times who reported it. So they missed that as well. So what was the function all of these years for the consumer protection? I think you make a great point. But I want to go back to the markets for a second, because when you see that decline of 1,100 points the other day, when you see this volatility, what's it based on? I mean, when you look at the backdrop, as Pete just mentioned, wages up 2.9% year over year, growth in the economy 3%, people talking about 4% up for 2018. You know, earnings up 20% for 2018. What is this decline based on? It's not based on fundamentals, right? Is it purely valuation?
Well, I think that certainly triggered it were concerns about higher interest rates, from the Federal Reserve.
But does 3% scare you? I mean, come on. You've been a student of this market for 25 years. 3%?
You know what does scare me, and we've talked about this repeatedly on the program, that you've had a Federal Reserve and central banks around the globe that have pumped an unprecedented amount of liquidity.
What happens when that stops?
Cheap and easy money, and it is stopping.
Yeah.
And I'm not talking about
Enter tax reform.
Right. I'm not just talking about raising interest rates in little stair steps. I'm talking about a $4.5 trillion balance sheet that they're slowly reducing. Now it's at $4 trillion. So essentially, they have pumped money into every corner of the financial system. And there have been wild bets placed in ways that I don't think we yet understand. You saw all the money that was shorting volatility, not just through these exchange traded products, but in other ways, because the markets were stable. So people made stupid bets.
Well, not to
the
mention
market's
debt
not going to,
debt service that gets that much more expensive.
The market, it's unprecedented to have a market. The Dow only moved 1% or more 7 days last year.
Right.
The Dow went up 10 months in a row. That hadn't happened since 1959. Well, so to think that that's the normal, despite the backdrop of good news. And by the way, the danger is that when you have all that money finally filtering down to the hands of individuals through higher wages and they start spending it, that's actually when you get inflation. That's real inflation that the Federal Reserve will have to fight.
It's been one of the amazing things to watch in all this. There's been so much talk for such a long time about the need to increase wages because there's been such a discrepancy in the economy where the average worker is not getting a lot of money. As soon as we start to see an uptick in wages, then there's a lot of concern about inflation, and now their 401ks are tanking. So it's sort of like a no-win situation.
I don't know about tanking is the right word. You're still up. Come on,
still
give
up
me
for
a break.
the year, but still, I mean, now we're starting to see volatility again, which is making everybody nervous who's place their retirement in the stock market.
And I think that's right. Volatility is back. But isn't it true that volatility can be a friend, Chris?
Yes.
Well, I think so. I think as you start to look at it, you all mentioned a word that's crucial: inflation. The cost of things are going to go up 3 to 4% each and every year, so we have to make sure that we're growing our money. I think volatility can be a good thing because if you are investing in your 401k consistently, you are even getting things when it's on sale. When things go down, you're buying on sale if you're doing it steadily. So now when things start to climb back up, you experience what they call growth. But again, it's that consistency with a long-range plan that will end up causing you to become recession-proof in your own personal economy.
I think you have to expect more volatility this year. I think you're going to see wild swings all year just because volatility is back and people aren't sure about valuation.